installment. How much? We made a third installment of 20,000. So, what will be the closing balance on 31/12? To balance carried down. It will be our credit side as a greater total 105,575. So that total we have to take it on the debit side, and the remaining balance is 105,575 minus 20,000 already paid, and the remaining balance is 85,575. So where we will take it? We will take it to 1/1/2012 by balance brought down. And how much is the balance? It is 85,575. Then what we need to do? The last installment was paid on 36/2012. So up to that date, we have to credit the interest. So we will credit the interest up to 36/2012. The balance is 85,575 multiplied by 5% multiplied by 1/2. Because this 5% is per annum. Here we are doing only for a 6 months period. So the total will be 85,575 plus 2139, 87,714. So 87,714. So what happens when we reach the date 36/2012? We make the entire payment. The balance is 87,714. The entire balance we have made a payment because we got the money from the buyer of the partnership firm, 1,40,000. Out of that, we will settle the A's executor's balances. So A's executor account is finished. So initially got 1,40,000. 1, 2, 3 installments of 20,000 we have paid, and 3 times we have credited the interest also. Finally, his balance was 87,714 as on 36/2012, which we have paid to him. So 87,714 we have settled the A's executor account. So now we will set aside A's capital account, executor account. Now we'll move on to the remaining partners accounts. The remaining partners, they continue their business. So we have to work out the current accounts and capital accounts for the remaining period. Only for 1/1/2011 we prepared. You have to do it for the rest of the periods. So now we'll move on to the current accounts of the partners. So what happens? 1/1/2011 to 31/12/2011. 31/12/2011. They have continued their business. So what we need to do, we have to find out how much is the profits or losses they have made. So that profit or loss should be shared by only B and C. So B and C continue to trade on the same terms as previously, and the net profit for the year to 31/12/2011 before charging the interest due to A's, it amounted to 32,000. During that period, partners' drawings were B 15,000, C 8,000. So what we need to do, first we have to share this profit. So what is the profit? By profit and loss account. So 32,000 was the profit, and we have to deduct the interest paid to A's executor. So how much interest paid to A's executor? In June we have paid 3,000, and in December we have paid 2,575. So those amounts we have to paste here. So these are minus. These are the interest paid. So after paying the interest, how much will be the remaining? 32,000 minus 3,000 minus 2,575. The amount will be 26,425. So how much this guy will share? The new profit sharing is 2:1. So 26,425 multiplied by 2/3. And he will take a credit of 26,425 into 1/3. 8,808. And during this period, they have done some drawings. So, see how much they have withdrawn? 15,000, see 8,000. So, in the current accounts, we'll write 2 drawings. You can write 2 drawings or 2 bank account, whatever. So, 2 drawings. How much drawings they have made? This guy has withdrawn 15,000 and this guy has withdrawn 8,000. So now we have to see which side is greater. As far as B is concerned, if debit side is greater, it is 25,000. In the case of C also, debit side is greater, it has an amount of 28,000. Now we will take these balances here. 25,000 and 28,000. So now what we need to do, we have to do the balancing by balance carried down. So to take it to the next period. In the case of B, it will be 25,000 minus 17,617, 7383. In the case of C, it will be 28,000 minus 8,808. It will be 19,192. So what happens? We'll have to take this further to the next period. For next period starting date 1/1/2012. So on this date, the firm is dissolved. That we should remember. But we have not got the money. Only the firm is dissolved. So write to balance brought down. And we have to take these two amounts here as the opening balance of this particular debit balance of 7383 and 19192. At this stage, what happened? The firm is dissolved. So what we will do during the firm is dissolved, we will prepare a realization account. So we have to prepare a realization account. For that purpose, what we need to do, we have to prepare the capital accounts and current accounts, and we have to have all the assets and liabilities. So let's move on to preparing the realization account. Before realization, what we'll have to do is we have to have the balance sheet. So how to prepare the balance sheet for this particular partnership firm? It's little tricky. If you work out, you will understand this is a little tricky one. Because we don't have the assets. They always talk about, if you see, they talk about current account. They talk about goodwill, but they say don't show in the books. And they are telling the assets are valued 36,000 in excess. But they are not saying what is the actual value of the assets. If you look at the joint assurance policy, they show the amount, but what happens is it's already matured on 1/1/2011. So if you are going to prepare the balance sheet as on 31/12/2011, what are the things we have? We don't have much information. We have very little information. We have only the liability side, capital account and current account. So now we have updated the capital account and current account here. So this one also we have as on 31/12/2011. These are the capital account balances. These are the current account balances. And we have A's executor. We have the balances of the A's executor as well as on 31/12/2011. So only this much information only we have. So from this information, we have to construct the balance sheet. So what we'll have B's capital account, B's capital account, and C's capital account, and we will have having a executors account. So A's executors account. Somebody joined. Yes. Sorry for the disruption. Somebody joined the meeting now. Okay, so we have the B's capital account, C's capital account, and A's executors account. These are the credit balances we have. So let's move on to A's capital account. How much is 20,000? So I have to take it here. B's capital account balance is 40,000. C's capital account balance is 20,000. And A's executor as a balance of capital, we have A's executors account 85,575. And then we have current accounts. A's current account is already transferred to his capital account. So now current accounts. B's current account and C is current account. Both of them are in a debit balance. So we have to show it on the asset side of the balance sheet. So what are the balances? The balances are 7383 19192. 7383 19,192. So now we have to see the total of the liabilities. Only liability side we have the full information. It is 145,575. If you put the total for these are the sundry assets. We don't know the breakup of the assets. So we have to show it as a sundry asset. It is simply the balancing figure we get. Because in the question they have not talked anything about what is the amount of assets and what are the different type of assets we have. So what I will do is I'll take the total of the balance sheet and minus these two current accounts. So the remaining should have been the balance of all other assets. So this is the tricky part in this particular question. So now we finished it. It is sundry assets balance figure. It is 1,19,000. Now I have to prepare a realization account. So it is you transfer to the realization account. Here, how many assets are there? We don't even know. We put it everything as sundry assets. Balancing figure 1,19,000. Any other assets? No. This is partner's current account. We should not transfer to realization account. This also capital of the partners. This is executor account. We should not transfer any of this to the realization account. Then what we will transfer? Only this one, sundry assets. We will transfer to the realization account. So I am preparing a realization account, particulars and amount. I put it as to sundry assets. To sundry assets. Since I don't know the name, I call it as sundry assets. 1,19,000. Are there any other realization expenses or anything? No, but we have to pay the interest. Final 6 years executor interest 2,139 is there. So that we need to debit to interest. In bracket A executor. Is executor. We have to pay. The amount is 2,139. Are there any other expenses? Anything? Nothing is there. Then we have to have the by bank account purchase consideration. Because there is only one buyer. They are buying it as a going concern. So how much is the agreed value? So the offer has been accepted. So now we will get 1,40,000. So 1,000 and now there is a profit. How much is the profit on realization? The profit on realization minus 2,139. It is 18,861. This 18,861 we should transfer to whom? To P's capital account. Only two partners are remaining now. So to B's capital account and to C's capital account, we have to transfer this. What is the profit sharing ratio? 18,861 into 2 by 3 and 18,861 into 1 by 3. So now we will have that 1,40,000 on the debit side. Now we should take this realization profit to the partner's current accounts 12,574 and 6,287. So now on when we will get this realization profits, we will get the realization profits only on 36/2012. So on 36/2012, we should credit the realization profit 36/2012. So by realization account, we have a profit. How much he gets? 12,000 574 6287. 12 574 and 6287. So are there any other entries? No, there are no other entries. Now we have to look at the balancing. So as far as B is concerned, is credit side is more, 12,574. So I will take the total here, 12,574. And the balance amount, since this is the last date, the firm's books will be closed by this particular date, 36/2012. We have to transfer to B's capital account. Current account we have to close by transferring it to capital account. 12,574 minus 7,383. It is 5,191. Now look at C's capital. Debit side is more, 19,192. I'll take this total to the credit side as well. And I will write 36/2012 by C's capital account. How much? 19,192 minus 6,287. It is 12,905. So now current accounts are settled by transferring to the capital accounts. Now we'll continue with the capital accounts. So we have the capital accounts here. On 1/1/2012, we'll have the opening balance. How much opening balance? The opening balances will be, this is gone already, so we have to show here. B will have 40,000, C will have 20,000. Now we have transferred some amounts on 36/2012. We have transferred some amounts here. So in the case of B, his capital account will get a credit of 5,191. So we'll write by B's current account. He gets a credit of 5,191. But in the case of C, he'll get a debit to C's current account. How much debit he is having? 12,905. Now we have to close the books. Here, how much we need to settle? In the case of B, he has a total of 45,191. On the debit side also, we should take it the same. And so we will get a final settlement of 45,191. And in the case of C, he has a credit balance of 20,000. That is more. So I'll take the same totally on the debit side. And this guy will get a settlement of 20,000 minus 12,905, 7,095. So with this final settlement, the accounts of the partners will be closed. So already we have closed A's executor account, partners current account, and partners capital account. So if you look at the balance sheet as on 31/12/2011, before dissolution, we had 6 different accounts. So now B's current account and C's current accounts are closed by transferring it to B's capital account and C's capital account. B's capital account, C's capital account, A's executor's account also settled by payment from bank account. And only one remaining thing was this sundry assets. This also transferred to the realization account. So the balance sheet becomes 0. No assets, no liabilities. So the books of the firm are closed. So this is how we have to deal with when there is a sale of partnership and coupled with death of a partner. We have seen when there was an admission of a partner, they continued the business for 1 year and after that they sold the firm. After that they continued the business for 1 year and then they have sold. So this is a different case. So any doubts or questions on this particular problem?
Sir, sir,
I don't see any questions, any doubts coming up. So, what I would suggest is we'll go for 10 minutes break. After that break, we'll continue with the other problems in this particular unit. See you after 10 minutes. Thank you. Yeah, tell me. So welcome guys after the break. So I think we can proceed with the next problem. Have you guys joined? Can we start?
Yes, sir.
Okay, thank you. So I'll share the screen now. So after all these tough questions, lengthy questions, we are moving into a slightly easier one. Since it's a different concept, we'll work out that one also. We'll move on to the next illustration. So this is a concept of apportionment of shares among the partners. When this situation arises, when a partnership firm is converted into a private limited company or a limited company, or a firm is sold to a company, then sometimes the company does not pay in terms of cash, they pay in terms of shares. So the purchase consideration they will discharge by means of shares. If shares are given as a purchase consideration, how it should be shared between the partners, that we are going to study. Very simple concept only. How we will apportion? It is basically as given in the question. It's as simple as that. In each and every question, they will mention how to distribute the shares to the partners, and we will go by that. So we'll see one example for that. Let's move on to the illustration number 8. Prabhu and Co. is a partnership firm consisting of Mr. Prabhu, Bola and Mr. Shiv, who share profits and losses in the ratio of 2:2:1, and Bhagwan Limited is a company doing similar business. The firm and the company provide the following ledger balances as on 31/3/2011. So we will concentrate only on Prabhu and Co.'s ledger balances. We are not worried about Bhagwan Limited's balances. It's not required. So in the debit balances, plant and machinery 2,50,000, furniture and fixed 25,000, stock and trade 1 lakh, sundry debtors 1 lakh, cash at bank 5,000, cash in hand 20,000. Partners capital, Prabhu 1 lakh, Bola 1,50,000, Shiv 50,000, General is 50,000. Sundry creditors 1,50,000. It was decided that the firm Prabhu and Co. be dissolved and all the assets except cash in hand and cash at bank and all the liabilities of the firm to be taken over by Bhagwan Limited by issuing 25,000 shares of 10 each at a premium of 2 per share. Partners of Prabhu and Co. agreed to divide the shares issued by Bhagwan Limited in the profit sharing ratio and bring necessary cash for settlement of their capital. The creditors of Prabhu and Co. includes 50,000 payable to Bhagwan Limited. An unrecorded liability of 12,500 of Prabhu and Co. must also be taken over by Bhagwan Limited. Then what we need to prepare? The realization account, partners capital accounts, and cash in hand and bank account in the books of Prabhu and Co. Prabhu is a partnership. First, journal entries in the books of Bhagwan Limited for acquisition of Prabhu and Co. So, in Bhagwan Limited books, what were we required to do? Only pass journal entries. That too, with respect of acquisition of Prabhu and Co. So, that's why I told, just ignore whatever is given here about Bhagwan Limited. Plant and machinery, furniture, stock, whatever they have, they don't have, we are not bothered. not going to affect our solution. It's simply to confuse us. They have given some additional information. We have to just ignore it. We need not do anything about those balances. And as far as this partnership firm is concerned, we have to prepare a realization account, then partners capital account and cash in hand and bank account. So here what they have done, they dissolve in the same date. So we are not worried about what happened, whether any partner admitted, any partner retired or died, what kind of situation, whether we should prepare the profit and loss account for the interim period. All those confusions are not there. Straightforward question. So we can use this particular realization account. So what is different in the realization account? They usually say what is the purchase consideration. Like in the previous question, they have given straightforward. The amount paid is 1,40,000. But here that is not it. Here they say in terms of shares. So how many shares they are issuing? 25,000 shares. What is the face value of shares? 10. What is the issue price of shares? Face value of 10 plus premium of 2. So issue price is 10 plus 2, 12. So what is the total purchase consideration? 25,000 shares into 12, which is 3 lakh. So we have to calculate that. How we calculate? Simply add the share price and the premium. Face value and the premium, we get 12 rupees. We multiply with the number of shares, 25,000 into 12. We get the purchase consideration is 3 lakhs. So this is one thing we have to do in this question. And apart from that, these 25,000 shares are divided by the partners in their profit sharing ratio. So this is the apportionment of shares among the partners. Because of this particular line only, we are studying this particular question under this section. So it's very simple only, not very difficult. So wherever there is a share issued as a purchase consideration, the question will say in how we should distribute. So we have to follow that instruction, nothing else. Then the creditors of Prabhu and Co includes 50,000 payable to Bhagwan Limited. So in Prabhu and Co.'s books, we need not do anything for this. But when we are passing journal entries in Bhagwan Limited, we should not take these creditors because it's a Bhagwan Limited only. So it was a different entity. They were showing us creditors. But once it is inaugurated, what is it? Once it is integrated into the Bhagwan Limited, then we should not have these creditors. We have to cancel this. And again, then there is an unrecorded liability of 12,500. So in this balance sheet, there is an unrecorded liability. What to do? Prabhu and Co is not recognizing it because that's why it is unrecorded. But Bhagwan Limited wants to take over it. So we have to recognize in the books of Bhagwan Limited, and we need not recognize this in the books of Prabhu and Co. Because for some reason this has remained as unrecorded liability. Maybe they thought this is a contingent liability which will not crystallize, but Bhagwan Limited may think that in future this liability may arise. So that's why they are recognizing. So let's move on to preparing the realization account, partners capital account, and cash in hand and bank account. So one point to be noted is for settling the partners capital, they are doing, they are bringing necessary cash. So we will primarily pass entries in the cash account whenever they are bringing any amount as a capital. So let's start with the realization account. The first step is realization account. How we will prepare a realization account? We will transfer all the assets and liabilities to the realization account except cash and bank balances. So what are the various assets Prabhu & Co is having? The Prabhu & Co is having a on the asset side they have plant and machinery 2,50,000. So 2 plant and machinery. The value is 2,50,000. The next is furniture and fixture 25,000. So 2 furnitures and fixtures 25,000. After that they have stock 1 lakh, sundry debtors 1 lakh. After that they have only cash in hand and cash at bank, which we should not transfer to the realization account. So I will be transferring the stock to stock. The value of stock as per balance sheet is 1 lakh. And then I have debtors. The value of debtors is again 1 lakh. Now I have to look at the liabilities. Partners capital I should not transfer. General reserve I should not transfer. I have only sundry creditors of 1,50,000. So I am transferring the sundry creditors by sundry creditors. Value of sundry creditors is 1,50,000. Now are there any assets or liabilities? No, we have transferred all the assets and liabilities. Any assets or liabilities taken over by the partners? No, nothing like that. So all these assets and liabilities are taken over by the Bhagwan Limited. So we'll write Bhagwan Limited. How much they are going to pay us? They are going to pay us in terms of cash 25,000 into face value 10 plus premium 12. So 3 lakhs is the amount they will pay us. So now I have to see the debit balances and credit balances. On the debit side, I have 4,75,000. On the credit side, I have 4,50,000 only. So there is a realization loss. How much is the realization loss? 4,75,000 minus 4,50,000 is 25,000. Who will share this? The partners have to share by Prabhu. Prabhu is one of the partner by Prabhu capital account by Bola. I will shortly call as B. B's capital account. And third one is Shiv by S capital account. Prabhu, Bola and Shiv. So what is the profit sharing ratio? 2 to 1. So I'll distribute the realization loss into 25,000 into 2 divided by 5. And again Bola 25,000 into 2 divided by 5. In the case of Shiv, it is 25,000 into 1 divided by 5. So my debit balance and credit balance is tallied. So there is a relation, loss of 10,000 for Prabhu, 10,000 for Bola, and 5,000 for. Now what I prepare? Now I should proceed to prepare the partner's capital account. So let's move on to partner's capital account. So I'll say by balance brought down. This is it. This not required. Dates are not required in this particular problem like previous one. So I'll just hide. By balance brought down. What is the capital as per the balance sheet given? 1,50,000 and 50,000. 1,50,000 and 50,000 for the capital. Now on the liability side, we have a general reserve which was not transferred to the realization account because it has to be transferred to the part in their profit sharing ratio. So by general reserve, totally 50,000 and 2/5 of that will be 20,000. Again, Bola share will be 20,000 and Shiv's share will be 10,000. We got it because total general reserve was 50,000. It has to be shared in the profit sharing ratio. So what are the other entries to be passed? There are no other entries. Yeah, there is a realization loss to realization account. There was a loss of 10,000 for Prabhu, 10,000 for Bola, and 5,000 for Shiv. Now we have got the shares from Bhagwan Limited. So 2 shares in Bhagwan Limited, B Limited. I'm writing. So how much shares we have got? The total shares we have got is for the value of 3 lakhs. How much Prabhu will take? Prabhu will take this 3 lakh into 2 divided by 5. How much Bola will take? Again, this 3 lakhs into 2 divided by 5. How much Shiv will take? 3 lakh into 1 divided by 5. So 1,20,000 and 60,000 worth of shares they will take. So now we have to see how much cash they have to bring in or how much cash they can withdraw. So first we are seeing the case of Prabhu. Debit balance of 1,20,000. So it means what? It has to bring in cash. How much he has to bring in? He has to bring in a cash of 10,000. Now his capital is settled. Then we'll look at Bola's account. 1,30,000 on the debit side, 1,70,000 on the credit side. So we have to pay Bola. He has more capital. How much more he is having? 1.7 minus 1.3, 40,000. So the firm has to pay 40,000 to Bola to settle his capital account. And we are looking at Shiv's account. Debit 65,000, credit 60,000. So he has to bring 5,000 cash. Then only his account will be settled. So by this, we settled the partner's capital account. So next, what we need to do? We have to prepare cash account and bank account. So how much balance is there? 5,000. How much cash is there? 20,000. Since the partners are bringing in cash to settle their capital accounts, what we will do is ultimately we'll transfer the bank balance also into the cash account. Then we will settle everything from the cash account. System is a little bit slow. Just wait for a minute. So we have left with a bank balance of 5,000. We will withdraw that and add it to the cash balance, and we'll post the other cash entries. Then we'll be able to complete the problem. Sorry. So let me start with the bank account. In the bank, how much I had to balance brought down. I have a balance of 5,000. What I will do, I will withdraw. I will transfer this to cash by cash. I will withdraw this and move it into cash. So bank account will be settled. Excuse me. Then I will move on to cash account. So similarly, there will be a opening balance of cash. How much is the opening balance of cash? Cash in hand is 20,000. So I have opening balance of 20,000, and I'll write to bank. How much? 5,000. Now I will look at the capital accounts. What are the other cash transactions? So Prabhu has brought in 10,000. Shiv has brought in 5,000. Those entries I have to post here. To Prabhu capital account, P's capital account, and to S capital account, Shiv's capital account. Prabhu brought 10,000 in cash and Shiv brought 5,000 in cash. So total cash we have 40,000. What we have done with this 40,000? We paid Bola. So Bola's capital account. How much we have paid? We have paid an amount of 40,000. Look at his capital account. We have paid a cash of 40,000. So now cash account is also tallied. Debits and credits are equal. Opening balance 20,000, cash withdrawn from bank 5,000, plus Prabhu's 10,000 and Shiv's 5,000. Totally we had 40,000. Entire 40,000 we paid to Bola. So by this, cash and bank account also will be closed. Partners capital accounts also closed. So all the assets and liabilities are already transferred to the realization account and closed. So now the firm's account, this Prabhu and Co's books are closed. Now what we should do, we have to pass the journal entries in Bhagwan Limited. For what purpose? For the acquisition of Prabhu and Co. The they have acquired the Prabhu and Co. For this, we have to pass the journal entry. So how we will pass the entry? We will take the assets and liabilities. We have taken at the book values only. So now we have to plant and machinery. First assets we have taken over is plant and machinery. At what value we have taken over? We have taken over all the assets and liabilities at their book value, not at any different value. So plant and machinery we have to debit by 2,50,000. And then next will be furniture and fixture 25,000. Stock 1 lakh. Debtors 1 lakh. So furniture and fixture amount is 25,000. Stock 1 lakh, and then debtors also 1 lakh. These are the assets taken over. Then what are the liabilities taken over? The liabilities taken over is sundry creditors. So to sundry creditors. What is the worth of sundry creditors? As per the balance sheet, it is 1,50,000. So we have to credit this by 1,50,000. And then we have to unsecured liability also we have taken over to unrecorded liabilities. Rather, there was an unrecorded liability. So for that particular firm, it was unrecorded. Now we are recording in our books. So we cannot call that as unrecorded liability. We'll say some unsecured liability. Because in firm only it remained unrecorded. But now we are bringing it into the books of Bhagwan Limited. Still we cannot name it saying unrecorded liability. So we'll say unsecured liability. How much it was? 12,500. Then we'll have business purchase account. To business purchase account. This is the purchase consideration. How much is the purchase consideration? It is 3 lakh. The realization account already we recorded. It is 3 lakhs. Now you look at the debit balances. This total of debit balances 4,75,000. Look at the credit balances. It is 4,62,500. So effectively we paid 4,62,500 and got assets worth 4,75,000. It means there is a capital reserve. If assets are more and we paid less, it is capital reserve. If assets are less and we paid more, it will be a goodwill. So here in this case, it's a capital reserve of 12,500. What will be the narration? The narration will be being assets and liabilities of Prabhu and Co. taken over. So this will be the narration for recording the purchase. After purchase, what we do? We have to credit the Prabhu and Co. So how we do that? We will debit the business purchase account and credit to Prabhu and Co. To Prabhu and Co. So business purchase account will be closed and Prabhu and Co. will be getting the credit. We purchase of Prabhu and Co. Purchase of business of Prabhu and Co. So Prabhu and Co. got the credit. How we will settle the account of Prabhu and Co? We will issue the shares. By way of issue, we are making payment, we are issuing shares. So we have to debit the Prabhu and Co. and credit the share capital and share premium accounts. Just a minute, taking time. So we will debit Prabhu and Co account and credit our to share capital account, and we will credit our share premium account. How much share capital issued? 25,000 shares into face value of 10, 2,50,000. Amount of share premium to be accounted 25,000 into 2 rupees of share premium. So totally 3 lakhs. So Prabhu and Co will be debited by an amount of 3 lakhs. So now Prabhu and Co 3 lakhs credit, 3 lakhs debit, it will be closed. Being purchase consideration discharged by issue of shares at premium. So this narration is sufficient. Then what happens? Then there is a one more adjustment that we done. The creditors of Prabhu & Co includes 50,000 payable to Bhagwan Limited. So this sundry creditors is there, no, 1,50,000. Out of this 1,50,000, 50,000 was Bhagwan Limited's balance. So it means what? In Bhagwan, sundry debtors. So in Bhagwan Limited sundry debtors, there will be a balance of 50,000, which will show Prabhu and Co. So when the Prabhu and Co and Bhagwan Limited was different, we can show as the creditors and debtors. But these same creditors, now we are incorporating into the books of Bhagwan Limited. But we are already having as part of sundry debtors. So now we have to eliminate the sundry debtors and sundry creditors. So how we will do that? We will debit the debtors. Sorry, we'll debit the creditors. Sundry creditors. How much? 50,000 we will debit. And to sundry debtors, they will be credited by 50,000. So both of our creditors and debtors will come down by 50,000 because it's a elimination of mutual owings. Elimination of mutual indebtedness. We can say mutual indebtedness. So this will be the final journal entry. Once you pass all these journal entries, Bhagwan Limited's plant and machinery, furniture and fixtures, stock debtors will increase. Creditors also will increase. An unsecured liability will be recorded now. And this business purchase account is cancelled here. So it will not be part of the financial statement. Capital reserve will be created. This Prabhu and Co also again is cancelled. So in creditors and debtors also will be decreasing by 50,000 each because of mutual indebtedness should be eliminated. So any questions or doubts? Okay, then we will move on to the next problem. Illustration number 9. P and Q were carrying on business, sharing profits and losses equally. The firm's balance sheet as on 31/12/2011 was on the liability side, capital accounts of P 1,50,000, Q 1,30,000, total 2,80,000. Sundry creditors 80,000, bank overdraft 45,000. And on the asset side, they have 1,60,000, building of 48,000, debtors of 75,000, stock 70,000, joint life policy 6,000, profit and loss account means accumulated losses of 30,000, drawings account P 9,000, Q 7,000, total 16,000. The operations of the business were carried on till 30/6/2012. Sorry, P and Q both withdrew in equal amount of the amount of profit made during the current period of 6 months after charging depreciation of 10% per annum on plant and after writing off 5% on building. During the current period of 6 months, creditors were reduced by 20,000, bank overdraft by 5,000. The joint life policy was surrendered for 6,000 before 30th June 2012. Stock was valued at 84,000 and debtors at 68,000 on 30th June 2012. The items remained the same as at 31/12/2011. On 30/6/2012, the firm sold its business to PQ Limited. The value of goodwill was estimated at 1,30,000 and the remaining assets at the basis of balance sheet as on 30/6/2012. PQ Limited paid the purchase consideration in equity shares of 10 each. So this is the only difference. We have done a very identical problem earlier. You can go back and check. You will realize this. All these things were exactly same. So only one difference. PQ Limited paid the purchase consideration in equity shares of 10 each. You are required to prepare balance sheet of the firm, realizing partners capital account showing final settlement between them. So what we have to do, we have been given a balance sheet, but the date of the balance sheet is 31/12/2011. On the same date, the business is not sold. The business is sold after a period of 6 months, but they have not. So we have to, what we have to prepare? We have to prepare a profit and loss account for this particular period, but they have not given any figures for the purchase, sales or expenses. Then what we have to do? We have to compare the net assets of 31/12/2011 and the net assets of 30/6/2012. So based on that, we have to find out the profits made during the period. So a similar question we have already worked out. So it's in the same lines. So you can work out on your own. And if you have any doubts, you get back to me, that I will explain. Can you just tell me at least which problem it was where we have done a very similar question? We have solved a very similar question. Balance sheet was given, but the business continued even after the balance sheet date. the illustration number 6. If you look at the illustration number 6 and this illustration number, this is 9, they are exactly same. So take the illustration number 6 as a model and work out this particular problem. Very, very identical problem. There is nothing different between these two problems. So you can work out this on your own and you can get back to me. So I think with this we have completed with the chapter on partnership, unit 1 and the unit 2, and please go through the study material as well as the practice manual, and if you have any questions you can get back to me. This notes and all these Excel sheet which I have used in the class, I will circulate today that you can use it. So in the next class we will start with a different chapter.
Okay.
If you have anything to be clarified, you can let me know now. Otherwise, we will discontinue the class. We'll see you in the next class.
Thank you.
Okay, thanks for joining. See you all in the next class. See you.